Today, we're diving into the psychology of market crashes. Why do investors panic? Why do bubbles form? And most importantly, why does history keep repeating itself? Stick around, because understanding this is the key to protecting your wealth. Every investor likes to think they're being rational. They read the reports, they watch the analysts, they track the data. But here's the uncomfortable truth, backed by Nobel laureate Daniel Kahneman. Humans are predictably irrational. In a bull market, when prices are soaring, our brains get a hit of dopamine. It's the same chemical that gets released when you gamble. We start chasing profits, not logic. We convince ourselves that this time, it's different. We tell ourselves we're smart, but really, we're just riding a wave of euphoria. That right there is how a bubble is born. Then comes the real fuel, greed, disguised as opportunity. During a boom, everyone wants a piece of the action. It's the classic fear of missing out, or FOMO. The media blasts headlines about record highs. Social media influencers promise once-in-a-lifetime gains. Your friends and neighbors start bragging about their overnight profits from some stock you've never heard of. Greed spreads like a virus, and it's far more contagious than reason. Suddenly, the price of an asset isn't based on its actual value. It's based on whatever the next person is willing to pay for it. But what goes up emotionally must come down emotionally. When the first cracks appear, a bad economic report, a slight dip in prices, the very same crowd that was greedy yesterday becomes terrified today. And this is where another powerful psychological bias kicks in: loss aversion. The pain of losing money is scientifically proven to be twice as powerful as the joy of making it. So, people don't sell because the data tells them to. They sell because they can't stand the thought of losing another dollar. Everyone rushes for the exit at the same time, and that stampede is what turns a dip into a crash. Behavioral economists call this the herd effect. It's our primal instinct to follow the crowd, especially when we're scared or uncertain. When people see others panicking and selling, their brain screams, "I should be selling too," even if their own investments are perfectly sound. In the 2008 financial crisis, billions of dollars were pulled from the market by investors who didn't even own the toxic assets that caused the problem. They were just following the herd. Fear spreads much faster than facts, and in a market crash, the herd is almost always running off a cliff. From tulip mania in the 1600s to the dot-com bubble of the late 90s, all the way to today's hype cycles, the story is always the same. The names and the technologies change, but the emotions, greed and fear, are constant. Every single generation believes, this time, it's different. They think new technology or a new paradigm has made the old rules obsolete, but it never is. Because our technology evolves much faster than our psychology. We're still running on the same emotional software our ancestors had. So, how can you stay rational when everyone else is losing control? First, question the narrative, not just the numbers. If everyone you know agrees that something is a sure thing, you're probably too late to the party. Second, learn to track your own emotions. Feelings of extreme excitement or gut-wrenching panic are your biggest warning signs. They are signals to step back and think, not to act. Finally, focus on long-term fundamentals. Market noise fades, but true value endures. As the economist Robert Shiller wrote, markets are driven by stories, and those stories shape our reality. Market crashes don't just destroy wealth, they reveal our deepest human nature. Understanding that psychology is the first and most crucial step toward becoming a truly wise investor. Because in the end, it's wisdom, not emotion, that separates survival from regret. If you found this valuable, subscribe and click the bell to join the pack. Be a wise wolf.